In this presentation, I will review Chapter 2 exercises S21, S22, S23, S25, S26, and S29. I would suggest that you work these short exercises yourself and then come back and watch the video to check your answers. In this exercise, we will state whether the account is an asset, liability, or equity account. The best way to learn these is to review a chart of accounts such as the one in your textbook on page 59, and you will eventually learn them also as you work more homework problems. The reason it is important that you know what type of account these are is because it determines on which side the account is increased or decreased, which is called the debit or credit side. Notes receivable is an asset, common stock is equity, prepaid insurance is an asset, notes payable is a liability, rent revenue is equity, taxes payable is liability, rent expense is equity, furniture is asset, dividends equity, and unearned revenue is a liability. In this exercise, we are first going to identify what type of account each of these are because that will determine which side, debit or credit, the account is increased or decreased on. Remember that assets, expenses, and dividend accounts are increased on the debit side and decreased on the credit side. Liability, revenue, and common stock accounts are increased on the credit side and decreased on the debit side. This is probably one of the most difficult parts of accounting for new students. You will eventually learn this, but until you do, try to use some type of memory tool such as all elephants do love rowdy children. The first letter of each word corresponds to the accounts that are debited to increase, assets, expenses, and dividends, and those that are credited to increase, liabilities, revenues, and common stock. Our first one is increase to accounts receivable. We know that accounts receivable is an asset and assets are increased on the debit side. The next one is a decrease to unearned revenue. Unearned revenue is a liability and it would be decreased on the debit side. Cash is an asset, and if it is decreased, it would be decreased on the credit side. An increase to interest expense is part of equity, so an increase, though, to interest expense, which decreases equity, would be a debit. It is an expense. An increase to salaries payable is a liability. Liabilities are increased on the credit side. A decrease to prepaid rent. Prepaid rent is an asset, and if we decrease an asset, we credit it. An increase to common stock is an equity account. If we increase an equity, we credit it. Increase to notes receivable is an asset. If we increase an asset, we debit it. A decrease to accounts payable is a liability. If we decrease a liability, we debit it. And an increase to interest revenue is part of equity. Specifically, it increases retained earnings. So if we increase a revenue account, we credit it. This exercise tests if you can determine the normal balance for an account. Remember that the increase side is the normal balance side. So assets, expenses, and dividends have a normal debit balance, and liabilities, revenues, and common stock have a normal credit balance. Then you just have to know if the account is an asset, expense, dividend, liability, revenue, or common stock account. Notes payable is a liability, so it would have a normal credit balance. Dividends is an equity account, but dividends decreases equity, so it has a normal debit balance. Service revenue is a revenue account and part of equity. It increases equity, so it has a normal credit balance. Land is an asset. Assets have a normal debit balance. Unearned revenue is a liability account, and liabilities have a normal credit balance. Common stock is equity. An equity account will have a normal credit balance. Utilities expense is an expense account which decreases retained earnings, which is part of equity, so it has a normal debit balance. Office supplies is an asset. Assets have a normal debit balance. Advertising expense is an expense account. It decreases retained earnings, so it has a normal debit balance. Interest payable is a liability. Liabilities have a normal credit balance. This exercise and the one following is to see if you can journalize transactions. Remember that every transaction must have at least one debit and one credit. Sometimes you may be able to determine the credit or the debit more easily. If you can figure out one, then it is easier to determine the other side. Sometimes if you can determine the effect on cash, then the other side is easier. This exercise says that John Daniel opened a medical practice in Sacramento, California, and had the following transactions during the month of January. On January 1st, the business received $34,000 cash and issued common stock to Davis. Cash is an asset. If we increased it, we would debit cash. If we issue common stock to Davis, then we would credit common stock. So our entry would be on January 1st, debit cash $34,000 and credit common stock $34,000. On January 2nd, we purchased medical supplies on account. So we know that we received an asset, medical supplies. When we receive an asset, we would increase it, so our debit would be to medical supplies. We notice that we purchased this on account, so that means we did not pay cash. Remember, if you see the words on account, it's either going to be accounts receivable or accounts payable. In this case, it would be accounts payable because we purchased something and we received credit. So the transaction would be a debit to medical supplies for $17,000 and a credit to accounts payable $17,000. On January 4th, it says we performed services receiving $1,600. Since this transaction says we received $1,600, that means we got cash. If we receive cash, which is an asset, we're going to debit it. So our debit will be to cash. If we performed services, that means that we have revenue. So our credit will be to a revenue account, which is called service revenue. So our transaction will be debit cash $1,600, credit service revenue $1,600. Our next transaction says that we paid monthly office rent of $3,000. So we know when we pay something, that means that we have decreased cash. When we decrease cash, that means we're going to have credited cash for $3,000. What did we receive or what did we pay for? Well, we paid office rent. Office rent is going to be an expense. So our transaction would be debit rent expense for $3,000 and credit cash for $3,000. On January 15th, we recorded $7,000 revenue for services rendered to patients on account. Again, we see the word on account. When we have received or we recorded revenue, then the on account will be where we extended credit to our customers, and so our debit would be to accounts receivable. Since we performed a service for these patients, that means our credit will be to a revenue account, and in this case, service revenue. So our transaction will be a debit to accounts receivable $7,000 and a credit to service revenue for $7,000. In this exercise, it says that Harper Sales Consultants completed the following transactions during the latter part of January. On January 22nd, it says that we perform services for customers on account. Again, when you see the word on account, you're going to be thinking either accounts receivable or accounts payable. In this case, it's going to be accounts receivable because we extended credit to our customers. So our debit would be to accounts receivable, and the credit would be to a revenue account since we perform services, so it would be service revenue. So our transaction would be a debit to accounts receivable $7,500 and a credit to service revenue $7,500. On January 30th, it says that we received cash on account from customers $8,000. So when we see a transaction like this, we know we received cash. So cash is an asset, so we would have a debit to cash, and then we see the words on account. So what this means is that we have had customers that have come in and paid us for amounts that they owed us. So we know when customers owe us, it's accounts receivable. Accounts receivable is also an asset, but since we're decreasing it, it would be a credit. So to record this transaction, we're going to debit cash for $8,000 and we're going to credit accounts receivable for $8,000. On January 31st, it says that we received a utility bill, $220, which will be paid during February. Okay, so this means this is a utility bill for this month of January. So that will be an expense that we need to record for this month, but we're not paying it now. We're going to be paying it in February. So when we're going to be paying something at a later date, then it's going to be an accounts payable. So to record this transaction, we're going to debit utilities expense for $220 and we're going to credit utilities payable for $220. It says on January 31st that we paid monthly salary to salesmen $2,500. So this means that we paid an expense, which is salaries expense, and we actually paid it. So this is going to be a credit to cash. This is not going to be a payable for the future. So we're going to debit salaries expense $2,500 and we're going to credit cash $2,500. On January 31st, it said we received $2,310 for 3 months consulting services to be performed starting in February. Okay, so we know we got $2,310. So that's cash. We know cash is an asset, and so we're going to debit or increase cash for $2,310. But let's look at what this says. It says we received this for services that we are going to perform in the future in February. So this is not going to be service revenue that we can record in this month. We want to wait and record this service revenue in the months that we're going to perform it in starting in February. So we're going to record this $2,310 as a liability, unearned revenue. That way, if something happens and we don't actually perform these services, then we would have a liability recorded so that we could give the money back. And it also helps us to keep track of it, so in the months where we actually perform the services, we would actually record service revenue. So to record this transaction, we would debit cash for $2,310 and we would credit unearned revenue for $2,310. The last transaction on January 31st says cash dividends of $950 were paid to stockholders. So we know when we pay out cash, cash is an asset. We decrease cash by crediting it. So we know we have a credit to cash of $950. When we pay dividends, dividends are a specific account in our equity accounts that we record payments that we make to our stockholders. So it's not an expense of the business, it's a return of their capital. It's a return of money that the business has made or that we're giving back to our stockholders. So we would debit dividends for $950 and credit cash for $950. In this problem, S29, it says we're going to calculate the debt ratio. So they give us some information for Aladdin Carpet Care. It says they had assets on October 31st of $200,000, liabilities of $30,000, and equity of $170,000. So that would be correct for the accounting equation. And then it says, what is Aladdin Carpet Care's debt ratio as of October 31st? Well, the debt ratio is determined by taking your total liabilities and dividing those by your total assets. So in this case, the debt ratio would be the $30,000 of liabilities divided by the $200,000 of assets, and that is equal to 15%. And this is the conclusion of the presentation of the exercises for Chapter 2.